top-down analysis, it is an approach to the market, the way you approach the market. As traders, we have different ways of approaching the market. The way you approach the market, we will know the kind of trader you are, because the kind of trader you are depends on the approach you use in trading the market. So top-down analysis is you analyzing the market from a higher time frame to the lower time frame. You analyze the market from a higher time frame, then you scale down to a lower time frame for your entries. This is an approach that works in every other strategy. There are strategies those strategies can work effectively, but at times it looks as if it's not functioning or it's not really working, because most of those strategies are being used on a lower time frame. Those strategies are mainly used on lower time frame. That's why at times it looks as if that strategy is not working. But if you should apply the knowledge of top-down analysis to a particular strategy, so top-down analysis, I don't see it as a strategy. I don't call it a strategy per se. I prefer using the word approach, because I see it as an approach where a trader perceives the market to make precise decision. So how are you seeing the market? You see the market from the bigger picture perspective, where you analyze the market from a monthly time frame. Analyzing the market from the monthly time frame doesn't mean that you are executing. When it comes to the market, you have two things to do when it comes to the market. One is analyzing the market. The second is execution. That is all. Market analysis and execution. So we use the higher time frame just to analyze the market. You don't trade on higher time frame. I keep getting these questions. If we can trade the higher time frame, let me show you something why you can't trade on the higher time frame. Let's go to monthly time frame. For instance, this is a monthly time frame. Okay, today is 1st April. Happy New Month to each and every one of you. Today is 1st April. And because today is 1st April, this is monthly time frame. A new candlestick got opened today. This is this tiny bearish candlestick that is forming. Well, as of yesterday, when we were on this call, we were still on this bullish candlestick. So if you're telling me if you should trade on a monthly time frame, understand your risk to reward ratio. That if you are going in on this monthly time frame, you know that the market is going to buy, and you are entering on a monthly time frame, your stop loss will be wide, will be somewhere here. And how will you reach 287 pips just for this trade? Risking 200 and something pips is too much. Is a large risk, which even your big account, traders that are even trading bigger accounts, they don't risk up to 200 pips. Most of them, the highest they risk while swinging can be 100 pips while swinging, if they are swinging for a long term. If they are swinging is a short term, they risk between 40 to 50 pips. So why are you now risking much just to make something little? So that's why I said monthly time frame is only for you to know the overall direction of the market. You don't trade on monthly time frame. It's just for analysis. Being able to see the market on a higher time frame perspective. So now I can stand on a monthly time frame and I see what the market will do for the next 1 month. I will see what the market will do for the next 2 months. But when you are on a lower time frame, analyzing on a lower time frame, if you start your analysis on a lower time frame, you can't see what the market is going to do for the next 1 month. You are only seeing the market on a lower time frame perspective. Just like using your sight to see something. If you're having a sight problem, and within the period you're having sight problem, you will see things in a blurry way. Things will be blurred. It doesn't mean that you are not seeing those images, but you can't see images from a far direction. So someone that doesn't have issues with his eye within that period can see something afar. So those that are analyzing the market just from a lower time frame, it's just as if they can't see what the market is going to do for a long term. So they can be in a bullish market while the market on a long term is bearish. And maybe the bullish market they are in has given them money. They are still expecting more, not knowing that such expectation will not occur. Why? They are seeing the market on a lower perspective. They can't see what the market is going to do on a long term. So top-down analysis helps you to see what the market is going to do on a long term. So how do you get to know that someone is a swing trader, that someone is a day trader, and someone is a scalper? It all depends on the time frame of their execution, the time frame they are using in executing their trade. So someone reached out to me, I'm a day trader. So how can I use top-down analysis as a day trader? I said it's possible for you to use top-down analysis as a day trader. It's possible for you to use top-down analysis even with any other strategy you must have mastered before now. So top-down analysis, I don't see it as a strategy, even though it can be a strategy, but I don't see it as a strategy. I see it as an approach, the way a trader perceives the market. So no matter the strategy you are using, once you open your chart, go on a higher time frame first. 4 hours is a higher time frame, but it's not just an higher time frame. Go on a higher time frame first. When you go on a higher time frame, you'll be guided that even though you are a day trader, you know the foresight that you are having while you are on a trade. That you may be trading and you don't know that you are trading the pullback in the market while your target is still high. Instead of minimizing your target, I'll bring an illustration to this chart after this illustration. Not knowing that your target shouldn't be high because you are just trading a pullback. If you are trading a pullback, you need to know when you should go out of the market. So top-down analysis, you see, with a top-down analysis, from a nutshell, it means that you are analyzing the market from the higher time frame. So first, let's see how a swing trader will perceive the market from the higher time frame perspective. Let's see how a swing trader will perceive the market from a higher time frame perspective. This is how a swing trader, I'm going to also do for a day trader as well. So from this particular market, we've seen that the market is giving us a bullish. This is a bullish market. This is a bullish market from a higher time frame perspective. This is a bullish market. So from what I did yesterday, you can use your okay. This is the trend. This is the trend. This is the trend, and we are expecting price to come into this level. We're expecting price to come in here. We're expecting price to come in here. Remember that market moves from zone to zone. Market moves from zone to zone. So currently the price is at this zone. Price is at this zone. So where is the next zone that price is going to approach? This is the next zone at which price is approaching. So now you are guided that market is moving to this level. This is the next level price is going into. And you must have now understood the next level, that the overall direction of this market is bullish. Then you move to your weekly time frame. What do you do? What do you do on your weekly time frame? On your weekly time frame, you plot your key levels. So these are our key levels. You plot. If you want to see how to plot your key levels, you need to go back to the first part of this video. That's the first part of this class that we did yesterday. I've dropped the video. You learn how to plot your key levels. So you plot your key levels on a weekly time frame, where you still know that this is where price is heading to. Price is heading to this. This is the next region where price is going to. Already, the market has gone high already. Going into this market here will be too risky. So what are you going to do at this point? You need to observe the pullbacks. You need to pay attention to pullback. That is where your Fibonacci tool is really important. So this is for the weekly time frame. What did I say that the weekly time frame is used for? Use the weekly time frame to mark your key levels. So these are our key levels. Region where we have our support and resistance. Region where there is where we have different turning points. The moment price goes into that region, there is a turning point. The region where price holds from breaking below or breaking above. So these are the region of our support and resistance. But I don't just call it support or resistance, because when you are standing on a higher time frame, that is the weekly time frame, to plot your key levels, it will mark out your support and resistance at once. This key level is a guide. The key levels is just like a guide to you. It guides you to know the next level price is going into. If you see that price moves from one zone to another, so you know that once price comes into this zone, the next level is the next zone. So we are done with the weekly time frame. Then you move to your daily time frame. What did I say the daily time frame is used for? The daily time frame saves, or it is used to mark the trend, in marking the trend that is in line with the overall direction. And what is the overall direction saying? The overall direction is saying bullish. So now you are coming to look out for the trend that gives you a bullish market. So you are marking out the trend that gives you a bullish market. So this is the trend. You see that the market has been moving upward for a while now. You mark out the trend. In one of our videos, I've dropped a video on how to draw a trend line as a professional trader. I've dropped that video. So if you haven't watched it, you need to go back to the video and watch how to draw a trend line like a professional trader. Because if you don't know how to draw a trend line properly, eventually you end up entering into trade that must have been invalid. And you may still think that the trade is valid, but the trade is invalid. So go and watch that video on how to draw a trend line as a pro. So now we are able to mark this trend line. We are able to mark a trend line on the daily time frame. So the daily time frame helps you to spot the current trend. So this is the current trend. And at this level, what is the market doing? The market has already gone high. If you buy at this point, see, this is the trick in this thing now. If you should buy at this level, because you know, okay, this is the next target of the market, so okay, let me buy from here. If you buy at this level, there is a tendency that the market just drop and you'll be at loss. And is how if you should sell at this level, there's a tendency that the market can buy and you will be at loss because you are selling and the market is buying. See, this strategy guides you so that you don't jump into the market with because of how you are feeling or because of your emotion or entering into an impulsive movement. This is an impulsive movement. So this approach can guide you from entering into an impulsive movement as a result of how emotional you are. Because of how emotional you are. So that you won't enter into an impulsive movement, you need to wait for a good retracement into this trend line. Why? You want to buy in this market. The overall direction is saying buy. This is what you can see on the higher time frame. That's why I said you don't have to, you don't place your trade on the higher time frame. You need to scale down to a lower time frame where you can see a price at a comfortable price to buy or sell. So now we want a comfortable price for us to buy in this market. You want a comfortable price for us to buy. And if truly you want to buy at a comfortable price, you need price to come into this trend line. You need price to come into this trend line. The moment price comes into this trend line and you've now gotten a confirmed entry, you can then go into the market for a buy. Imagine a trader that is buying from here. Imagine a trader that waited and price came in here and the trader now got a confirmed entry here and now the trader is buying to this level. This is a massive movement upward. This is a massive movement upward. So this is why you keep hearing that a trader that is patient makes the money, while the impatient traders gives their money to the traders that are patient enough. So you have to be patient as a trader. So now you don't place your trade on a daily time frame. You need to scale down to a 4-hour time frame or 1-hour time frame to get a confirmed entry. So we move to our 4-hour time frame. This is a 4-hour time frame. I said something yesterday that this is 4-hour time frame, and we are expecting price to come in here for us to start buying. And trading at some point can be boring. For you to wait maybe for the next 1 week before price comes in here without trading, that is where swing trading reduces the tension of wanting to trade every day. That is where swing trading reduces. But if you're a trader that maybe you are a day trader, at times being a day trader doesn't mean you need to trade every day. There are some days you may not have entries. Doesn't mean because you're a day trader, you need to trade. Being a day trader means that as a day trader, you go into the market within a day, you must have taken your profit. So being a day trader doesn't mean that you're a trader that trades every day. It means that you're a trader that whenever you come into the market, you end up leaving the market that same day. You don't hold your trade for days, unlike swing traders. So being a day trader doesn't mean you are trading every day. So there are some days that you don't have an entry. Will you still force yourself to still trade because you are calling yourself a day trader? No. But there are some times that as a day trader, you can see opportunity every day, depending on the instrument that you are trading with. So you can see opportunities with different instruments. Today, maybe you've gotten an entry on GBP USD and you've taken your profit. The next day you trade another pay like that. If you trade, let's say different pays, let's say 3 pays, and the first day you've gotten an entry with a particular pay, maybe before that pay can give you another entry, it can be maybe after 2 or 3 days, and after 2 or 3 days that pay is now giving you another entry for you to enter the market. So maybe out of the 5 trading days we have in a week, you can be fortunate to have a good trading days, up to 4 trading days. That doesn't mean that you must be trading. If there's some week that you trade only once, because it's only once that you've gotten a good entry. There's some week that you can see up to 3 opportunities. There's some week that you can see up to 2 opportunities. That is it for being a day trader. So I said something, trading can be boring, that waiting all this maybe as a day trader. This is where most day traders are not aware of. This is what they are not aware of. That the market remember, the overall direction of this market is pointing bullish. So most day traders, that if they're analyzing the market from a 4 hours, they are just seeing the market from a 4-hour perspective. This market that you are seeing on the 4 hours, and it's as if the market is looking bearish. Yes, it can be bearish, but is the bearish going to be for a long term? It's going to be for a short term. So maybe they must have made money to this level, and the next thing is that they are still expecting price to keep dropping, and the market is not dropping, and at that point they end up giving back their profits to the market. But when you are guided from what is happening from the higher time frame, and you are coming in as a day trader, you now know, even though the overall direction is bullish and I am bearish in this market, I am trading bearish just for a short term, you are guided. You are guided because you've seen the market from what the market is doing on a higher time frame. Then you can scale down to your lower time frame, like the day trader, their entry is 15 minutes time frame. You go to your 15 minutes to get a refined entry at 15 minutes. That's for day traders. So I said for this particular trade, if I want to enter for a bearish market, remember what we said about breakout, a counter trend breakout. Can you see that price had broken out of this trend line, and price had retested on that trend line, and now is giving us a bearish candlestick out. A bearish candlestick is now out of that area. Can you see? So at this point, maybe if you've gotten, maybe just wait for this candlestick to close, and you can now think of entering this market from this point, from this level to here, because price definitely is coming here. Why? This is a counter breakout, and I've seen a breakout and a retest, and there's a bearish candlestick forming already. So for day traders, most day traders, they trade depending on time zones, London or New York session. Those are the time zones that most day traders trade their market. So in one of our class, I'll talk on the different time zone in the market, so that to those of us that wants to also go into day trading, you can still understand the time that it is more nice or much preferred for you to trade the market, because as at now, the market is not going to do much movement. Yes, the market is not going to do much movement, unlike the London and the New York session. The market, but the thing is that while some day trader can miss some opportunities, these out in the middle of the night, the market might become volatile. At times you wake up and you see the market must have done a bigger move, which if you were not in that move, you can't find possible retracement immediately. That is where swing traders take to benefit more, because while they are even sleeping, the market is still moving. Even though the market might move slow, but towards the morning time, you can end up seeing the market moving with big moves at some point. That one is by the way. So if you are entering this market, you need to know, oh, I'm entering bearish or I'm selling in this market, but me selling in this market is just for a short term. So I'm expecting price to move into this region or somewhere that my Fibonacci 2 will eventually highlight. So you can still use your Fibonacci 2 somewhere here. Okay, let's use our Fibonacci 2 to get the accurate pullback of this market. Just note that the market is pulling back after this massive impulsive movement. This is a massive impulsive movement. So price needs to retrace to a certain level of retracement. That is why we use our Fibonacci 2. These are Fibonacci 2. You pick from swing low. This is the low that sponsored this impulsive movement. This is the low that sponsored this impulsive movement. So you start from the low and extend it from 1. If you see the number that is being calibrated by the side, from 1, you extend it to swing high, which the extension is 0.236. Already, price has gone into our 50, 0.5%, 0.5 level, our level of 0.5. I say something that I prefer price to come into the 0.618 most times. Yes, it works very well. So I prefer highlighting my 0.618. So this is the level of my 0.618. Let me take off the Fibonacci 2. I've taken off the Fibonacci 2. So now, I'm now guided if I'm selling in this market. Is either price comes into this 0.618 and I will take my profits. And if I leave the market at this level, I'm not entering again. I will need to observe because at this level, there may be some trick that will occur. Price might break this level to the trend line region, or price might eventually respect this 0.618. The moment price respects this 0.618, expect the market to be bullish. Expect a bullish market. Or if price doesn't respect this 0.618, eventually price will come to respect the trend line that is close to the 0.618, giving us a confluence. That we have a confluence at the trend line, a confluence at the Fibonacci retracement. We have a confluence of our candlestick pattern that will give us a confirmation entry. I think I've been talking since the beginning of this class for more than 40 minutes now. So I want to know, are we really picking what I'm saying? Let's ask questions. Ask question before I continue. Ask question. Ask question.
Yeah, good evening.
Yeah, good evening.
The question I want to ask now, I saw you making use of Fibonacci extension. I didn't see you using your last point, 0.2 something, instead of something. So I don't know how you make use of that your own, because I was thinking you will use Fibonacci extension, but Fibonacci extension. Does it mean that when price is actually in a continuation, you use that extension, or it's just the same?
Sorry, your voice is really breaking. Can you type? We'll wait for you. Can you type? I can't really hear you very well.
Can you hear me now?
Okay.
Hello.
Yes, I can hear you.
I said I saw you using Fibonacci extension, and you pointed at 0.2 something as your swing high, at the swing high. Then I'm asking, is it the same thing? Because this Fibonacci extension and Fibonacci retracement is actually complicating issues. So I don't know if it is the same thing. Because if it is the same thing, why then you point your say your swing high at 0.2 something instead of doing 0.00, because you are starting from down to the up.
I've gotten your question. Yeah, Fibonacci retracement tool and saying Fibonacci extension, they are the same thing. Why? You are extending. Let's go back to our chart. You are extending from a certain level to another. This is the level of your low, swing low. You are extending from swing low to swing high. From swing low to swing high. And your swing high is the region where, okay, your swing high is 0.236. We have many levels on our Fibonacci tool, but the most important level, if you check your Fibonacci tool, it is not as neat as this, because those are the default state of the default format of that Fibonacci tool. Once you customize it to pick only the areas that are important, well, because there are some levels that are not relevant when it comes to this. There are some levels that are not relevant. The levels that are very important is the level where you are extending from and the level where you are extending to first. The next level is the level of your 50% retracement. And the level of your 50% retracement is the 0.618 and 0.5. These are the areas where you have your 50% retracement going into. And note that you use your Fibonacci is only used for a trending market. The moment price moves into your 50% retracement, and you are, for instance, this is a bullish market, and you are expecting a buy. So let's say that price is moving. Okay, price has now gone into our, this is our 50% retracement. Yes, and we are now buying from here. Our next target, our first target is here, where price is going to come and give you a kind of a double top, which, you know, before a market will give you a higher high. Remember the structure of the market. Before the market will give you a higher high, the market must have first given you equal highs. So at this point where price is coming into your equal highs, there's a tendency that price might react first to your equal highs before making a higher high. So in this market, if price is going to make a higher high, expect price to come into this region of this zero region. This region that is highlighted with 0, that is the next target. So in this our extension, it means that we are extending from swing low. Price now comes into our 50% retracement and our next target. Let's do this. Swing low, swing high. This is swing low, giving us a higher low. So you expect price to give a higher high for it to be on a bullish trend. Once the market can give a higher high, remember the structure of the market, of a bullish market, higher highs and higher lows. So your Fibonacci retracement tool, these are the levels that are important. So now, if we are entering at 0.618, our overall target is at this 0 level. That price will come in there before making any other movement. Price will have to come into that level. I don't know if you understand what I'm saying. Do you get it?
Yes.
Yes. So if there is any other thing you must have heard about the Fibonacci level outside this, I don't think that is correct. So I don't think that is correct. This is the most realistic way of using your Fibonacci retracement tool. This is the most realistic way of using your Fibonacci retracement tool. It helps you to understand the trend in the market. You can be guided. So once you are extending from your swing low, your 0.236 is your swing high where you are extending it to, and the zero calibration that you are seeing above 0.236 is just a figure where you are now expecting your bullish market to come into. So your bullish market is going to go into that region. So let's just see if we have any previous market that we can use in. Let's look out for a previous market. Let's see this swing low, swing high. Can you see it? Can you see it?
Yes,
Unmute your mic. Can you see that the moment price went into that zero level calibration, that price retraces?
yeah.
Can you see? I extended it from the swing low to the swing high, and price came into your 0.618 level, and the moment price was heading higher, first, price reacted to the 0.236 level first, because that is a minor level. That is a level. So at that point, price it will look as if it is a double top, but it is not a double top. That is where you can take your partial profit, because the moment price went into that level, what happened? Price came down a bit before heading higher again. So at that level, you can take your partial profit, because anything can happen in this market. This is you trying to guide yourself from giving yourself into the uncertain market. You put measures, preventive measures. This measure will guide you to understand what you should do before entering, and what you should do while you are in the market, and what you should do after the market, after you must have left the market. So now, once price, this is your swing low, price came into, okay, swing low, you extended it to this level, this is our high, this is the high, this is the high, where our 0.236 is, and price now came into our 0.618, where we take our entry from here for a buy movement. Remember, the moment price moved into this 0.23, there is a short reaction at this level, because it will react to what had happened before. The moment price came here, what happened? Price came down. So you wouldn't expect price to come in here. At some point, there's that price coming here and keep pushing upward. But at some point, most times, when price comes into a level like this, price reacts first before moving higher. So now price is now moving higher, coming into this level. This is the level that is giving us a higher high. This is a low, high. Price came and give us a higher low. So you are expecting price to give us a higher high. So this is the level at which price is now coming into. So that is the same thing with this bigger move. So if you should plot your key level, if you should extend your Fibonacci like this. So now because you take out your Fibonacci tool, you take it away so that your chart will be clean. You just need to highlight the areas that are very important. So personally, I do highlight the area that I want price to come into. So I'm expecting price to come in here. I'm expecting price to also come in here. This is me trying to guide myself. So now, the moment price moves from here, the moment price moves from there to here, This is this is a region of our Fibonacci retracement, even without the Fibonacci tool again, because I had already highlighted this level. So now I know this is the region of my Fibonacci. I'm just waiting to see the candlestick reaction here. This is how price comes in here and is still bearish. Why? Maybe the market just want to fulfill all technicals, that price might be dropped into this level. In case price doesn't come in here and maybe price just came in here and you've gotten a candlestick confirmation, that is a bullish candlestick confirmation. We've done candlestick pattern. So you've gotten a candlestick pattern here that has given you a bullish confirmation. Great. You just jump in here, and if you are jumping in here, that means your first target should be here. Even though this is your overall target. This is the overall target in this market. But your first target is here. Why? If you check the left of the market, price had reacted at that level. So there's a tendency that price will come in there and react. And meanwhile, this is our region of our minor resistance level. This is a minor resistance level. Remember what we said about resistance level, that price holds from breaking above at resistance level. So once price goes into your resistance level holds price from breaking above. That is what we said about the resistance level. So now, the moment price comes in here, there's a tendency that price will hold here first before breaking to give us a higher high. Since this is a bullish trend, we are expecting price to make a higher high. Are we okay? Is that explanation okay? Do you have any question? Before we move on. Any question? Let me know. Ask your question. Unmute your mic and ask your question. Meanwhile, this video will be dropped tomorrow, or if possible, I can still drop it after this class. I will find a way to drop this video after this class. So that you can watch it again. It will guide you to understand this concept clearly. So tomorrow, do you have any question? Mba, how about you? Are you clear? Are you clarified?
Yes, I'm clarified on that. But
okay, great.
But let's just proceed.
No, if you have a question, just ask.
Okay, my question now is, based on this structure now, 4 hours structure, at least we have identified that we are now trading on the pullback, and our bias is now bearish. Meanwhile, the overall trend is bullish. So my question is, I would have loved seeing that chart so that I will also be knowing what I'm
Oh,
saying.
you love to use the chat. Hello?
Yes, I would have loved to see the chart so that.
Okay, let me share my screen again.
At least now, 4 hours time frame, we are seeing that it is bearish. So what we are looking for now is an entry to enter the market, right?
Yes, from 4 hours.
So if we should be going down to lower time frame, it's still confirming that we are still bearish, not bullish, until when we meet that overall trend line that will now push.
Definitely, yes. So if you are going to your 15 minutes, you see that yes, the market had broken out from that trend line, and it has retested. So it's just for you to look for a refined entry, an entry that can give you a sell signal from here, but you need to be guided. that this market is bullish in overall direction. So if I'm in this market, I should know where I should leave the market. I should know where I should leave the market. Not, there's how you are in the market and you see, as you having much expectation. So coming down to, let's say your 15 minutes, if you can have an entry here on your 15 minutes, good. You can now trade. This will make you be a day trader, right? This will make you be a day trader because you are now trading with a 15-minute time frame. 15-minute time frame shows that one is a day trader because you getting entry on 15 minutes is mainly for day traders. Is that one clarified?
Yes. Thank you.
Are you okay? Hello?
Yes, it's enough.
Okay, great. Any other question? Okay, in absence of any other question, I will end this class, and in the next 20 minutes, I will make sure that this video is out so that you can watch it before you sleep. And if possible, just practice what we've done today in class. It will make your memory to be fresh concerning this particular class. Is that okay?
Okay, I want to ask something.
Okay.
Okay, if I heard you clear and still following, from the beginning, you started from one time, the direction, which the word there, direction. On the week, don't look for that have not been tested. On now use trend line to know the possible place that the price will come before it gets the energy to push further, right?
Okay.
So, and in 4 hours for an entry, you don't see an entry, you go down to 1 hour time frame to look for either other stuff, right?
Okay.
So okay, let me not. Since you say you would speak, because this one, I can see that you speak top down analysis. Down analysis from, but
have you asked your question?
As a trade that as I am, will my time frame analysis start? Must it start from that monthly, or will I use daily 4 hours, 1 hour, and then 10 minutes to the month?
Okay. The thing is that yes, why you are analyzing the market, let's say from that monthly time frame, is just for you to be guided. You are not executing, or you are just guided. This is how the overall, like what you've just done, the overall is saying bullish. But coming to lower time frame, it is giving us a bearish movement. So now in your mind, you know that now that I'm in this market, I should position myself for a more bullish opportunity, even though I'm in a bearish market. So I'm selling just for a short term. I know where price is going into while I'm selling for a short term. That is just it. Are we okay?
Yeah.
Are you okay?
Yes,
Okay, that's fine. Any other question? Okay, in absence of any other question, thank you for joining me today for this class. I'll be dropping this video soon, so please try and go through the videos. If you have any issue, drop me a message. I'm active. I will respond to you.